Okay.
Yeah. Hi everyone. So this is Finance Meets Real Estate. We have Taing here today. So he's the CEO and founder of 2Z Capital. He's an experienced real estate investor with 100 million assets under management, and he's also an economist by training from the Wharton School of Business. He has experience leading data science and analytics at Apple, Capital One, and AT&T. His company focuses on high cash flow investments and providing passive income to investors by acquiring and optimizing multifamily, industrial, and senior living assets. So I'm really excited to have him here today. He's going to talk on minimizing taxes with real estate. I think that's his favorite topic, and he knows he's like one of the big experts on that. So that's with that, I'm going to pass it on to Ang. Thank you.
Thanks, Stefan. Appreciate it. I'm going to start sharing my screen. Let me know if you can see it. Yes?
Yeah, that's great. Perfect.
Okay, so my favorite topics, real estate and taxes. And I think they go hand in hand. It's really a match made in heaven. And probably one of the reasons why people do real estate investing because how tax advantage is. So for those who have been doing real estate, hopefully this is a lot of stuff that you're familiar with. If those who aren't familiar, hopefully after this, you guys will try to figure out how can I get into real estate. A little bit of background about me. As Stefan said, I have a background in Wharton in economics. I was an investment banker, trade a lot of derivatives, did in the Peace Corps, did analytics, worked at iPhone team, product manager, most recently corporate America and data scientist, and now have founded 2Z Capital, which is a syndication private equity company with 100 million of assets under management. And thematically, throughout the whole time, I have also been a real estate investor. Obviously, starting at 2009, very lucky timing, although I was also an investment banker before that. So yeah, that was not as lucky. I also want to say that I'm not a tax professional. If I had a tax professional here, they would tell me this is educational entertainment purposes only. This is essentially what I do for myself. So everybody else, there's a lot of just make sure you talk to your CPA if you have any actual questions on some of this stuff. And by the way, if you guys have any questions as I go along, feel free to ask, interject. A little bit of history, my real estate investing history. I bought my first property when I was 23, in a triplex in LA. I was living in DC, working Capital One, and I was doing out of state. And I've got really used to investing out of state. I think it's a very useful thing to learn how to do, to create processes in place. But I have always really invested for cash flow, and I did it every year, every other year, until California did not make sense for a cash flow perspective. I invested as a passive investor in multiple deals. And then I started to buy my own commercial real estate out of state in Georgia, Kansas, Missouri, and now Florida, Michigan, Texas. Haven't updated this slide in a while. And I syndicate multifamily, commercial, self-storage, and opportunity zones with historical tax credits. Also have a Bitcoin mining fund. Going for hours for that. My general wealth strategy, meaning I think this is how most people approach wealth, is you start by saving money. If you were like me and didn't come from money, and I grew up in welfare. I was born in a refugee camp in Thailand. Came here when I was young, 3 years old. So I didn't have much starting out. I had a job, I had many jobs, and I started saving, and I used that to invest. And as you start earning more money in the jobs I had that fortune, you realize, man, I'm paying a lot of taxes. So really, once you start saving money, there's so much extent that you can save. So you really have to start earning more money. So that's the next step. Once you start earning more money, you realize, man, I'm paying so much in taxes. Then you really got to figure out how to reduce your taxes, because taxes, if you're doing it right, will be your number one expense in life. So I think if you focus a little bit on how to reduce, minimize, defer your taxes, I think you'll achieve wealth much faster. So how to pay less taxes. really should be how to keep more of your earnings, because this is money that you earn. And if you are able to reallocate it, shift it, rearrange it, you're able to potentially keep more of it. So when it's about taxes, it's all about the facts. You have to rearrange the facts. And this whole presentation is all about rearranging things, shifting things from present to future, active to passive, post-tax to pre-tax, etc. So for those employees out there, and this has included me as of as of 2019, people are familiar with how you get paid. You get paid salary, you pay taxes on that, then you're able to spend money. This is what everybody probably knows. But if you're a business, you have the ability to get paid, spend money, meaning earn revenue, have expenses, and then pay taxes on net profits. This is a potentially better order of operations. And for most real estate, this is what it looks like. And for most employees, we're all about trying to shift, rearranging facts again. Your spend money, meaning stuff that you'd be spending on anyways, like retirement planning or stock investing, healthcare, childcare, from post-tax to pre-tax. And that's what 401ks are, if HSAs, FSAs. So most of our strategies on a day-to-day level are really about shifting spending from spending from post-tax to pre-tax. But if you're an investor, it's actually a better order of operations here, where you're actually able to spend money or invest, get paid on it, and then pay taxes. Although really, because you are able to invest, that pay taxes is reduced or even eliminated, or mostly deferred, actually. So I want to highlight one of my favorite types of strategy when you invest in real estate, deferrals. And deferral is one of the main elements of real estate investing. And I want to highlight three types of deferrals: depreciation as a deferral strategy, tender exchange as a deferral strategy, and opportunity zones. So let's talk about deferrals and why it's a good idea to always pay things in the future, if you can. If you're able to invest that amount now, you are able to have essentially, if you owed $100,000 of taxes and you could defer that for 10 years, and you were able to invest it into an investment and get 12% compounded and have it grow, you're essentially foregoing. Deferral is always about opportunity cost. You're able to invest that money, have it grow, and if you are just deferring the same amount of money to the future, now you've made 210,000 net difference. So that's when you use depreciation. That's what deferrals are all about. Essentially, taking losses from the future or not losses. You're taking losses now, taking from the future, having that reduce your present income. Meaning, if you have $100,000 of income and you take $100,000 of depreciation on passive income or real estate income, you could save that in marginal taxes. And a cool thing about depreciation is also that you can transform it. Not only is it being transformed from ordinary income but now it's transformed to long-term capital gains capped at 25%. So you're transforming it from now to future, and you're also changing the rate you're paying on it. Another thing that you want to keep in mind with deferrals is that inflation is your friend when it comes to deferral. What you owe now versus what you owe in the future is, if it's the same, that same amount in the future you owe, it's going to be worth less. Is typically, that's the trend for the last 20 years, or not 20 years, for the last history of money. And the inflation rate of 2% will make the money that you owe now cheaper in the future. That's also why I love having lots of long-term debt, because if I borrow $10 million on a 30-year loan, I'll owe that amount or a little bit less amortized, but that value of that loan will be less because my dollar will go less in the future, meaning that I want money in assets.
And sorry to interrupt. So just on your three examples, right, of deferral. So the OZ and 1031, that's sort of like an obvious deferral, right? It's literally sort of extending, sort of the period for your tax payment, to the future. But the depreciation is less obvious, I think. I mean, in the sense, isn't it sort of an estimate of the genuine, sort of a prorated annual estimate of the genuine depreciation on a property? Like, would you say it's necessarily deferred? It could be advanced in some instance, no? I mean, it's in that case. I'm just trying to understand your rationale.
So if you think about depreciation, and this is why I invest for cash flow. If I'm investing in a real estate in some real estate investment and there's no cash flow, that depreciation is being used now, right? It just keep getting carrying forward, and so that depreciation essentially nets out, reduces the cost basis of the property. So in the future, you get this recaptured. And if you never got any cash flow, that means you never used the depreciation, so then you wash out that gain. So on a non-cash flowing asset, there's no time shifting. On a cash flowing asset, you're time shifting that loss that you're now being able to use against the income of that property. If you're making 10% cash in cash, for example, if you have bonus depreciation, you use bonus depreciation, and you take 50% losses on your on your investment amount because you leverage up. Now you don't have to pay taxes on that 10%, and the next 4 years of 10%. And that's only on the bonus depreciation.
Okay, and I agree from this perspective. Yes, there's no clearly there's no explicit time zero cash tax benefit of in the event you don't have a positive cash flow to sort of offset the depreciation on. But purely virtually, would you say depreciation expense is sort of overly conservatively set by the IRS? Like, would you say it's not an accurate estimate of the annual genuine depreciation on the property? Because the reason I'm asking is I often hear it, it's like one of the main benefits of owning real estate, right? You have cash flow, you have depreciation, and things like that. Does that mean it's not a meaningful expense? Does that mean that was not meaningfully and purposefully set there because properties genuinely heavily depreciate and they're really difficult to maintain? That's also that perspective. It's just like a very sort of invisible estimate, in that sense. So just
it typically does mean that. It typically means that because real estate and this underlying value, due to real estate being a scarce asset and generally have forward momentum in growth, except if you're investing in stagnant cities or depopulating cities. Obviously, it still should be a good investment. That should be the number one priority. But if you're if you're looking at Amazon and how they defer their taxes or write off their taxes in 2019, they wrote off 10 or 11 billion dollars of taxes, and $8 billion of that. I might be having the magnitudes wrong, but some very big portion of that was written off because of bonus depreciation of hardware, trucks, data centers, real estate, and that allows them to essentially not pay taxes on present day cash flow and have to pay taxes on future cash flow. But in that case, that hardware, those trucks, they have less residual value. And so it looks like it's just basically a business expense. In this case, depreciation is just a business expense. Expense is something that it costs you money, or costs you value, present day value, that you're borrowing from the future. Depreciation is you're essentially borrowing from the future.
Okay.
I think this of Renee is staticky, throwing off my. Okay. So depreciation, if you think about you can have something that generates 12% cash in cash for 5 years. You invest 100K, and it potentially could have a 5 years of straight line depreciation depending on the leverage point and the land value. And this is pretty common, where you're essentially getting 12% that goes in your pocket, $12,000 a year, and you're not paying taxes on it in that present day, in that present value, which creates more to like a 17% cash and cash equivalents in other investing term mediums, right? So that's $22,000 of taxes saved in a 5-year period that gets recaptured in the future and we transform at a 25% rate. This is the $22,000 of taxes saved is assuming an ordinary top end federal rate of 37% at 2.8% on Social Security, et cetera, that's 40%. So that's straight line depreciation. Then there's bonus depreciation and cost segregation, which is taking parts of real estate, typically the non-building parts of real estate, and that would have a depreciation schedule of not 27 and a half or 39 years, but rather shorter, 5, 7, 15, and taking it in the first year, bonus depreciation. That came from the 2017 tax law. And I'll highlight a study here of one of my properties that we invested in last year, where within a 5 years window, we would, because we did the cost seg study, we took nearly $1.6 million of losses the first year, essentially 2020. Without that, we would have taken a straight line loss of 549 over those 5 years. So 100K in the first year instead of 1.6 million. And that 1.6 million has a net present value because of taxes, as well as the ordinary income, and as well as present day value, right? So that has, in this case, using a 3% discount factor, a $490,000 cash benefit value, assuming you can use that $1.6 million of losses against your other passive income or other real estate income or other income if you're a real estate professional.
Okay, so thanks. Sorry, just to interject. So just to explain, like for our audience, so the benefit of cost segregation is essentially, okay, by splitting sort of your assets, I guess, into their proper buckets, you would kind of optimize their capitalization period, to each of them, and you would thus, on aggregate, reduce your, your tax bill, such as instead of everything being, reduced straight line or on a whichever period, you would kind of be able to sort of bucket it in the most optimal way and sort of optimize the whole thing. And I assume that is that the benefit of like what cost segregators do essentially, and they are able to do this in a sort of more knowledgeable way than than on sort of someone who is not a tax professional would.
I don't know if it's more knowledgeable, but it's used to be an engineering study. I think the way I would think about it is like borrowing from the future. So, right, depreciation is borrowing from the future in a straight line, a little bit less aggressive, more like just average over 27.5 years. If you sell it within 10, you're only taking 10 of the 27.5 years. In this case, there are portions of the building classified in the 5, 7, 15-year property line items that are a small portion of it, in this case, 30%, 29% of the value of the property, that can be, with the bonus depreciation law passed in 2017, taking the first year. So it's all of this is about borrowing from the future to the present. The present losses is much more valuable than future losses, right? So straight line depreciation is borrowing from the future essentially shifting losses present, and then you have to be captured in the future. In this case, it's even more accelerated, more aggressive. You still get the bonus, you still get the straight line depreciation of that other $3 million property here, straight line for the next year and the following year till you sell. But in this case, you get such a big advantage in the first year.
And let's say, would any expensing for tax purposes fall under what you sort of, in your
contract? Yeah, any expensing for tax purposes.
Would be borrowing from the future.
Any losses
over a 5-7 year period is sort of a less, obviously less than that in that sense.
Any expensing, real estate essentially is a business. You got income, revenue, you got expenses, property management fees, vacancies, etc. I mean, that's not really expense, but that's a operating cost expense. You have depreciation, which is a phantom expense. That's not actually on your bank account in terms of money you lost. So that phantom expense allows you to wash out real income. And so, this law is actually very favorable. You can actually go all the way back to buildings that you bought since 1986 and do a cost seg study. The software out there costs $1,500 to do it. You pay around $5,000 to $3,000 for your own property. I think the break-even analysis I've done is if your cost basis was maybe around 600,000, 700,000, it makes sense to do it. Obviously, the bigger the scale, the more it's beneficial. So these are all things you could do. If you bought property, you should depreciate it, because on income producing property, the government will depreciate it for you. They're going to assume you took the depreciation. So if you're not taking it, first of all, you should fire your CPA. But if you're not taking it, then they're going to assume you took it. And so if you look at bonus depreciation, how it works against an investment vehicle like that, I talked about the straight line. In this case, using the same 12% cash and cash, you're taking depreciation 6,000 the first year, 8,000 the next year, because you're essentially shifting it, right? You're taking that 60,000, you're shifting the present day. So the next year, instead of getting 12,000, it gets reduced. But your taxes on is now negative the first year. Carry forward that loss, if this is on investment, carry forward the loss to you dwindling. So all that 12,000 gets neutralized as taxes. That 32,000 that carry forward would then, if sold in the fifth year, gets added back to the recapture. If this is complicated, I know this, but it's just about shifting, about borrowing from the future to the present. Net present value of cash is, or taxes not paid, is so much better. So let's talk about depreciation a little bit more and why I invest in the places I invest in, which is I'm like the leverage depreciation is leverage and land value. If you borrow money, if you buy something all cash, your cost basis doesn't change, but your percentage allocation of depreciation does change, because when you borrow money, the bank does not take any depreciation. So when you get lower leverage, you get less depreciation. This is also why I buy for cash flow, because cash flow means you have higher cash and cash, you can get higher leverage. And for commercial real estate, that's true too. So if I get lower leverage, I get less depreciation, less borrowing from the future. If I get higher land value, right? If I'm in New York, California, then my land value potentially is very high, and land cannot be depreciated on the property. You still pay for the land, you don't get any depreciation benefits of that land. It goes into cost basis, doesn't get recaptured, such all this stuff. But in the case of higher land value, you get less depreciation. So why I invest in Kansas City and other places similarly, I like buying cash flow where I can get higher leverage and lower land value. I can claim a 5% land value, which is historically accurate for Kansas City, and get an abnormous amount of depreciation. This is a straight line. On bonus depreciation, you get a lot more. So what can you depreciate?
So you just basically, you mean like land value as percentage of overall property value differing across regions, more optimal investing in like sort of the, in that sense, more optimized. Yeah. Sure.
So you can't depreciate land, but you can depreciate the property on land, improvements on land. You can't depreciate your own house unless you house hack or something, or rent part of it. It's a bit trickier. I don't get into that. You can depreciate vehicles. Buy a Tesla Model X, 6,000 pound vehicle, depreciate it, and use it for one day, in December 31st, as a business expense, and take 100% bonus depreciation on it. These are all things that you can use to reduce your income.
Yeah, and do you mind repeating the part on leverage? Actually, I think I missed that one, because my understanding is, okay, depreciation basis is purely sort of, I guess, more a function of land value, but I'm not sure how the leverage comes in. As in mortgage.
Yeah. So if you lever more, you can buy a bigger property value, right? Mm-hmm. So if I put 50% down on $1 million property, I'm putting $500,000. My $500,000 get the same amount of money, get the same amount of depreciation value or loss as if I put $1 million down with no leverage. So if I put $1 million down with no leverage, I'm getting the same amount of value of depreciation value as that 5 million. On a percentage basis, it becomes worse, right? So if you're putting 5% down, which is ridiculous, you 95% of the loan doesn't get any depreciation benefit. Banks do not get depreciation. You get all depreciation. So you could even get a 4-to-1, 5-to-1 write-off, which is insane. It happens.
Yeah, understood. Yeah, that makes sense. I thought there could be a sort of difference in a different sense, like between properties, but it's more like to a financing. It's like a financing kind of argument that I understand. Similar to income, sort of similar to levering income. It's levering the beneficial depreciation in this case.
So can depreciate, not depreciate? Hopefully, you guys understand that. So then deferrals, right? So now you depreciate all the stuff, you get the recapture. What you can do instead of paying taxes on that is to then use tender exchange. And for, I'm not going to dwell too much on this because hopefully you guys know, you can essentially identify property within 45 days, making acquisition within 180 days of a like kind property, take this higher cost basis, not high cost basis, but higher loan value, and essentially take the proceeds.
And sorry to interrupt. So just before we move into 1031, just a quick kind of conceptual thing on depreciation. I'm not sure that if others know it, at least I'm not 100% certain of if we have a physical asset and and conceptually, now IRS is not exactly going to be throwing money, right? So they want to there is a concept why depreciation exists, right? In a sense, separately we can optimize it and etc. and like have all those benefits too. But still there is a concept. And now what is the interaction of that concept with sort of the fact that those physical assets incur repairs anyways, that those repairs get tax benefits? Now, is there an aspect that's duplicative? And, in that sense, and what makes it not duplicative?
Yeah, repairs are an expense, and then capital improvements are a added addition to cost basis, right?
No, I understand that. But purely, if we take like an asset that is going to get, it has a certain value, it's worth, let's say $100,000 and it's going to get depreciated, over 30 years or 27 and a half years, right? And we're going to have simultaneously a set of repairs that are going to get incurred in each year. And we will be given sort of by the IRS a benefit each year for that depreciation portion, the depreciation expense. We're going to get, like a bunch of money from that essentially, especially if you have surplus cash flow. But, what is the driver of how this is set? I mean, it's a kind of an amateur question, obviously I'm not like a tax professional, and that's obviously no other in a series of other physical assets. It's not a real estate topic at all, but one thing I've been sometimes wondering is, okay, is that expense that is given to me maybe too much? And why is it given to me? Given either way you would expense your repairs, which is sort of another measure of physical deterioration of the property. Like it's like this kind of
yeah, it's a measure of physical deterioration of the property, additive to the depreciation, which is a measure of deterioration of
so
the cost basis, the division of cost basis, right?
Yeah, exactly.
And then and that's why there's a thing called depreciation recapture, because almost no properties actually get sold for less. You could get sold for less, and that's a capital loss as well.
Okay, I guess that answers your question. So sort of the recapture at the end is sort of the
it's a shifting,
pretty much. So that also supports your shifting kind of argument, and understood. Okay, I think that's a good. I think recapture is a good sort of answer to that.
So when you combine depreciation with tender exchange, it's very powerful. It's amazing synergy. For those who invest in real estate, they almost never sell and pay taxes. They sell and reinvest. And one way to do that is tender exchange. You essentially invest, get cash flow, get depreciation benefits. Now you reduce your cost basis, and you would have recapture, essentially pay taxes on that capital gains and any appreciation as well. But if you tender exchange, you then keep pushing that off to the next property, to the next life cycle of the property. Your cost basis gets carried forward as well. So potentially your cost basis could be zero by the second or third, fourth property. and you're pulling capital out from refinance as well, which gets you money, and the cash flow also is tax-free usually, or tax deferred. And the tenor exchange cycle is a powerful thing. A lot of people miss this one. Is you invest, get cash flow, you tender exchange, get more cash flow, tax-free, you tender exchange, and then when you pass away, your cost basis gets stepped up in basis to fair market value, and your heirs get don't get stuck with a zero cost basis, and there's no capital gains tax on it. So all that gets wiped out. All the depreciation of the losses that you're shifting from the future to the present, taking advantage of that, essentially the tax benefits of that from shifting is essentially now eliminated, not just shifted. And so that's the strategy of most people, and that's the strategy of me and of our investors. So very powerful. Essentially, when I talk about deferrals, with this strategy additive to it, you're now talking about elimination. And it's only really powerful when you also eliminate present cash flow taxes. So obviously cash flow is very powerful.
So what makes real estate eligible for 1031, and then let's say, for example, public equity is not eligible, and for example, and tokenized real estate not yet eligible for 1031.
Yeah, I think
I understand specifically.
Yeah,
is it that it's a physical asset, like?
That's a good question. I think there are evolutions to this that could be. I'm hearing that could happen. Obviously, opportunity zones is a slight evolution. There's DSTs for equities, right? You can do deferred sales trust and other interesting things. And that's all about shifting still. I'm not an expert on this, so in terms of, I just use the rules as people tell me, and I to the maximum advantage. In effect,
I've just been wondering myself.
Yeah.
It's incredibly beneficial. That's like a huge advantage over other assets. I mean,
it's insanely beneficial. And when I always ask people, when I was working at Apple and making a good amount of money, I realized that the real estate investors that I was meeting and talking to, they just weren't paying taxes. And I was like, how are you doing that? Like, yeah, depreciation. Like, they never really worried about it. And as an employee, I was thought like, I got to backdoor Roth IRA, I got to do all this stuff. Like, what is this? Like, no, they don't care about retirement plans because everything is tax free. It's great. It's amazing. All investors say.
So had they had an incredible cash flow, then they would be paying taxes, even with depreciation.
Yeah, of course. Hopefully, you've made more money than you've lost, and the depreciation is not infinite. In fact, you can lose that value, or not lose the value. There's a certain amount of cost basis that you can depreciate. So it does get less and less over time. Of course, what you try to do is buy more and more over time. And with real estate, that's typically very plausible and possible. So then the third deferral strategy, operating zones. One of my friends told me that Sean Parker was a lobbyist, or not lobbyist, but he lobbied for OZs in 2017 Trump tax laws. And you can imagine ex-president of Facebook wanted to have a vehicle to essentially defer capital gains on stocks, just like 1031 exchanges, except no elimination and more time bound. So after $1 billion, he looks like this. And every 1%er in Silicon Valley went in. And the OZ map is interesting because the genesis of it was really about creating opportunities or economic revitalization in different areas that are in need. But when you look at San Jose, for example, the new Googleplex and very high-end areas that have high income are also OZ. So it's really a political thing a little bit. But there's three main benefits to investing in OZs. One is the deferral. You talk about deferral. I love deferrals. That's probably my favorite benefit. Don't pay taxes now, pay in the future. In this case, you actually do have to pay in the future. There's no elimination on the present capital taxes. So if you sold $100,000 worth or $20,000 of Apple stock and your cost base is $100,000, you pay taxes on that $100,000. federal long-term, 23%, 24%. And then you would pay that in December 31st instead. So you can able to get a discount on your investment, compound that $24,000 in 12%, get bonus appreciation on that cost basis as well, by the way, because it's also a real estate investment. And then at the end of 2020, December 31st, you use about 10%. And then all future capital gains of that property, which includes depreciation and recapture. So all the the cost base that you reduce, even with no appreciation, just the depreciation that you've used gets eliminated because that's long-term capital gains. So many benefits, and it counts for long-term and short-term. I have investors who sold a lot of GameStop stock and made a lot of money there, and they're investing in OZ funds. Have people who've sold art. I'm not sure if anyone sold NFTs yet, but maybe that could be something in the future. And of course, real estate as well. And you can use real estate to do this, and it makes sense. Tender exchange makes sense when there's a lot of profits, but when there's a minimum amount of profits, that inflexibility of tender exchange is not as great as potentially just having the flexibility of operating zone, taking the profits interest and putting it into an OZ. So most people do use it for stocks, although some people would use real estate.
And just confirm, so typically like in an OZ, like where sort of the capital gains, they're reinvested into the fund, right? So kind of how does that part work? It's still a little bit less, I mean, it's great, it's super great, but it's still a little bit less useful than 1031. It's just one couldn't do a 1031 in every instance. You know,
it's a little bit less useful if you were doing all the strategies that I was doing before, but it's more flexible. If you think about this, if you have $1 million property and your profit is only 100,000, but you have no loan on it, it's kind of ridiculous. But you're no loan on it, you have $1 million proceeds, and you have to put in that whole $1 million into the next property. You put there's no loan on it, so you
absolutely, absolutely. That part is pretty much you know.
In that case, put the 100K into an OZ, use that 100K to buy whatever else, a bunch of different things. But if it's a bigger portion of that proceeds, the profit interest is a bigger portion of it than tender exchange. I think around 30% is really the magic number and above. Another thing here is that it's typically 180 days from when you sell whatever you sold that generate capital gains as an individual. LLC and other stuff is maybe a year. You put in the fund. The fund now is the 10-year clock starts ticking. The fund doesn't have to invest yet. It has 31 months to invest. So you could set up your own fund. But there's a special provision due to COVID, and I was shutting down last year, that allows investors to put in money from capital gains as far back as October 4th, 2019, meaning you sold stock in 2019, late 2019, your 180 days is over, but there's a one-time special provision to invest before the end of this month. So 8 days left to invest in the OZ fund. You can email me. Even if you had capital gains from last year, like, early last year, now you have this really long, after April 1st, that no longer applies. After this year, that 5-year window no longer applies. You don't get a 10% step up in basis, meaning that's 10% discount on your taxes. But if you invest in, the tax-free reinvestment goes up to 2041. So potentially that's still there, although deferrals and reduction is no longer. So these are time-bound benefits.
Okay, so if we look at, like, let's say a fund that an institutional investment fund or a syndicator who invests exclusively in opportunity zones, and we look on a total returns basis and considering like the tax benefits, let's say, versus people who don't, they invest entirely outside of opportunity zone. So would you say that the total return, how would the total returns compare? In the sense that you did mention there are some high income areas for, potentially for political reasons that happen to be opportunity zones, but more often it is areas that are, somewhat challenging, and, it could be that appreciation suffers in those areas as well. So what has been like, do you have like an intuition or sort of data? Oh, it's, it's more or less profitable to invest in opportunity zones.
Yeah, I think that's a little bit of a misnomer that it's a high crime area, high low income area. This what I was highlighting here was there's a lot of people that invested in non high, it's like San Jose is parts of San Jose, which is a very expensive area, is in OZ. Most opportunity zones are class A luxury condominiums because that's what most constructions are. And OZ typically needs to be construction, not always. But there's a premium on OZ land, typically, good OZ land. Typically, what I've seen is 5 to 10% relative to what they were priced at in 2016 before the law passed. They jumped up 10%. Now I realize I'm in OZ. The neighbors cross street and that line, it's not OZ, 10% less. Um, but that tax benefit is so significant, and I'll highlight that. We can see if I can. Let me. How do I?
A priori, wouldn't those be primarily, except some of those political regions that you mentioned, wouldn't those a priori be more areas that are in need of economic development that sort of are potentially struggling, and that's where the tax incentives would be provided?
Yes, but that's what we think, but that's not always the case.
Not always the case,
And
exactly.
it's not always the case. And so I want to highlight this tax benefit here of
Yep.
if you really care about the gains because that's what you pay taxes on. If you had a 15% return on your investment in the case of someone who invests back into stocks, pay taxes on that going in. So now you have only $76,000 to invest in, $76,000 gross, 15% compounded. You then pay taxes on the exit, and your ROI is 2.5x. So pretty good. But in this case, you put in the whole 100, you pay 10% less, so the 24K equals 21, 6 years in the future, 5.5 years in the future, grow the same rate, that gets subtracted. No exit tax because and this has been taking advantage of all the depreciation that you would have taken in the first day. So that's another huge benefit there where you essentially, that I'm not counting on, but essentially you're getting around 50% higher returns on your money. So on a relative basis, if you're looking at a non-OZ versus an OZ, it probably has to be around a 4.5 to 5% higher annual return compounded to have the equivalent based on the tax benefits. So it's significantly, you have this huge delta, right?
Like 5% annualized is the difference. That sort of for the non-OZ needs to have 4 or 5% higher annualized return to match the OZ investment.
So pretty big. So I mean, all this is like try to make sure you have as much of an advantage when it comes to investing. Obviously, the number one thing about investing is that it should be a good investment. But if you can get a discount investment, if you can get some benefits, present day cash flow investments, then it gets harder to fuck up. It gets harder to mess that up and not take that advantage. So, gonna close it out. I know we're running a little late. Shifting active to passive. You can turn active Airbnb income to rental income by placing an entity on top of it and being a shareholder of the entity, or like put a long-term rent. You have two entities basically. You shift from now to later. That's what I talked about a lot. Opportunity zones, 401ks, shift from high to low. Pay your kids. I have a TikTok on that. I think that's like 2 million views. Pay your kids if your kids are of some reasonable age, $12,000+ and the tax bracket being progressive, they don't pay taxes on that, and now you reduce your income by $12,000. This is all, by the way, all much easier to do when you're owning your own business, not W2 employee. Shifting consumption expense. As a business owner, I use a lot of my stuff for a business. This office is an expense. If I was working at a W2 job, this would not be able to do that. After tax to pre-tax. And another thing you could do is shift passive to active. All those losses that you've gotten from all the strategies I've highlighted, depreciation, shifting from future to present. Now, what are you gonna do with that? you can't use it against your W income because it's passive. There's three silos of income here: active W2, portfolio stocks and capital gains, and um, passive real estate, mostly in business interest. Um, but in some cases, you might want to change that passive because you have so many losses to active. And if you're a real estate professional or married to one and filing jointly, you can shift that um, uh, to act that passive losses to your active income and write off your entire active income as a W-2 employee, which is what I did. Throw a quote here. You know, most of you guys hopefully know this. Get rich from real estate. Another quote, Donald Trump. That makes me start. And to hit it home, this is what I've been doing. This is what I do. I pay zero tax per income. So that I made a lot of money, but I did not actually pay many federal taxes. California taxes I still pay. That's just unfortunately can't get rid of that. But that's that 1.8 million loss is really the losses I've been able to take against my income because my wife is a real estate professional. I'm a real estate professional. So that is it, guys. Appreciate it.
I didn't unmute myself. That was awesome. Thanks, Taing. That was great. So let's open up for questions. We have a couple of questions already on the chat. And if you guys want to speak up as well. So I'm going to start with, so Han asked the question, if you can spend like a little bit more time on the things that can be depreciated slide.
So what can be depreciated? First of all, you can't depreciate your house you live in. If you were renting your house from a company that you own, you could depreciate that. That's very much a gray area. I'm not suggesting anyone do that, but you could do that. Then you can also write off your interest on that house. So lots of interesting things if you sort of start thinking like a business. You can depreciate patents, IP, software. You can depreciate, stuff, vehicles. We can't depreciate collectibles and stock. If you rent out half your house, you can depreciate half your house. It's kind of complicated. Don't want to get into that. And any rental income producing property. I'm doing Bitcoin mining. I have a $4 million Bitcoin mining fund. I am depreciating all that hardware 100% as a loss because that's income producing assets that I can depreciate that won't typically have any residual value unless Bitcoin skyrockets to $1 million. So another benefit there.
For the next question on the chat, so we have, one moment. I'm not sure if you see them actually. And so there is like, so Joao is asking, would you be able to share this? To share the slides. So that
happy to share the slides.
Yeah. And again, if you guys look at our chat at the beginning, I also put in so besides the slides, I also put in the YouTube, our YouTube channel. So feel free to subscribe there, and you will see the video recording as well. And then the next question so Mark is asking, how was the process of switching to professional real estate investor tax status, assuming you waited until you left your W-2 as the requirements are pretty strict?
Yeah, if you are able to convince the IRS that you spend the majority of your hours, your working hours, productive working hours into real estate activities and a minimum of 750 hours, which is 15 hours a week into real estate, and you have some material participation, meaning that you actually own, actively own, potentially as a general partner or something like that, then you can, it's just a checked box. You get checked box every year. And if you have a spouse who is not working in terms of corporate job, maybe as a stay-at-home spouse, you could take she could or he could take real estate professional status. And if you are a high income earner, then you could take those present day losses that I've highlighted and use that against your active income. There's a bunch of other strategies as well I'm not highlighting, but like land conservation easements, oil and gas, etc. Lots of tax efficient strategies.
Hi, Ang. I have a question and great presentation, by the way. Very informative, if I could
Thank you.
ask. I'm selling my minority share ownership interest in my business, and I'm going to be having about $75,000 in capital gains taxes for 2021. I was wondering what are a couple of good strategies utilizing real estate that I can do to kind of lower that at the end of 2021. Thank you.
Yeah, so for your minority interest, if that's profits, capital gains, the best way would probably just invest in an opportunity zone. That's where a lot of people are putting their money for profits from a business sale. If you were going to, if it was more significant and you had more cash or capital to invest, then maybe the real estate professional. But OZs would probably be the most efficient and easiest. Because when I talk about the real estate professional, there's two things that you need to do. You need to have income to offset to make it worthwhile, and you need to have losses, significant amount of losses. And a lot of times with real estate, you can get more than a one-to-one loss, especially if you leverage up and land value is low. In some cases, I've had 1.5 to 1, meaning I put $1 million in, I get $1.5 million of losses. Right. I'm also making like $100,000 a year in income that's tax-free because I shelter that. And so with the 75,000 of profits interest, I would just put it into OZ. That would be ideal. You have 180 days from when you sold it.
So I have a question. Oh, I have a question.
Hi, Janice.
Hi, thanks for the presentation. Very nice. So I have a question. So I'm not classified as real estate professional, which I grieve about. So, so I'm glad to hear 15 hours a week. You know, that seems doable, but utterly lifestyle change. But I remember this real estate subjects. So I was studying about this. So real estate professionals are not subject to the net investment income tax. But however, if somebody is, let's say, non-real estate professional who adjusted gross income for the year exceeds $200,000 if you're single, or $250,000 if you're married, joint filing, so then you're sort of out of luck. So your depreciation is sort of compensated by that net investment income tax, which is 3.5 excess 3.8% tax, right, for high income landlord. So accredited investors are usually classified as a high income landlord, right? And a lot of them who have money and want to invest in it. So are there any other tax strategies that you recommend to accredited investors?
So you're referring to 3.8%, which, you know, on top of a long-term capital gains of 20, that's why I talk about 24%. And I always highlight the high end because 15 is the low end. If, by the way, for the real estate professional, if you're not a real estate professional and you make less than $100,000 income, you can take those losses up to a certain amount against your active income. But on a progressive tax system, that's not as beneficial because the marginal tax rate is not that high.
Right.
As a accredited investor, one of the things I like to talk about a little bit, but not, I wouldn't necessarily propose to you because it's a little bit riskier, is land conservation easement. This is what a lot of wealthy investors do, what I know some of my friends and fellow investors do, where if you're making $1 million of income and you have land conservation easement, which essentially is a charitable contribution into an easement that essentially saying, I'm going to gift this thing of land and you're going to syndicate it. So you're going to buy a partial share of it. And I'm going to say, I'm going to build this really nice office park on this land. And now this land has a much higher use value. And then you donate it. It's very much like art. Art's all about tax shelters. I feel like everyone who does art is an NFTs potentially. It's about donating a higher value than you actually paid for and netting you essentially a 5-to-1 tip sometimes reduction in your AGI. So if you're making $1 million in your AGI, put $100K charitable contribution, not investment, you don't get that back. You get $500,000 tax write-off. And on that top end marginal, if you're in California, which is where I'm at, and it applies for California, real estate professional does not apply for California. I mean, you don't get the same benefits. I still pay a lot of California taxes. Now you're taking $250,000 of taxes off the table. So you made fairly large ROI, 100K nets you 250K of savings. So that you can do every year up to half your AGI. It is what, if you ask any CPA, they'll probably say this task force against it, blah, blah, blah. But I still see rich people doing it. I still see congressmen, senators do it. So who knows? Follow what rich people do, and wealthy people who have lots of real estate and lots of political clout. I don't have lots of political clout. I just like to ride the coattails of those who do. And almost every other congressman and senator are real estate investors. None of them are employees. So, oh, the employees.
Okay.
They're employees, but yeah, really, come on.
Yeah. So I think I'm okay. So good to know. But I think I'm more in the middle zone where, like, working professional, right? In that zone. So I think the dollar amount, I think something I would have to account for at the end. So yeah.
Yeah. So you put in like 50. Yeah. It's really only makes sense if you're making more than 300-400K on that sense for land of easement. Invest in oil and gas. That's as a one-to-one write-off on intangible drilling credits. Whether you like oil as an investment vehicle or not, I'm not particularly a fan, but that's I don't know as well enough. So
yeah, okay, different ways to go about it. Okay, thank you.
And so just a question. Actually, I'm going to start with a question in the chat. So Ron is asking, so other deferred tax structures besides 1031 and OZ?
Yeah, DSTs, deferred sales trust, installment sales. It's all about shifting present tax or future. I'm not an expert at those because I haven't used those myself. All these things I've talked about are things I've used myself that I've done. I've experimented on my own taxes. So that's why I can talk about it.
And okay, in your so because you're a real estate syndicator, right? And in that sense, so one question is, so do you invest only in OZ or you invest in non-OZ as well?
I actually don't really love OZ. So 10 years is a long time. I have so many other investments that I love that are shorter. But OZs are a great tax advantage, especially this year. There's no 10% reduction after this year.
But you have not, though. You have not done OZ for a while.
I have an OZ fund. I have 3 OZ properties. I've done lots of OZs. I'm doing lots of OZs this year, but I have lots of non-OZs as well.
Okay, understood. So in the non-OZ portion of your portfolio, so let's say you say you don't pay any real estate taxes, how does that work in the non-OZ portion? Because it's a syndicator, you're going to have your kind of acquisition fees. Aren't those, sort of, some of it are components that you can't.
You come as a syndicator or as an investor of the syndicator?
Syndicator, I guess, yeah. Or on that portion, it's not avoidable.
So you get depreciation percentage off the carried interest, right? The carried interest, because you're guaranteeing the loan, gives you the cost basis. So if there's a 80-20 percentage split, then you get 20% of the depreciation, and your cost basis is your guaranteeing the loan. So I have a lot of losses from owning real estate that will offset the active income from the fees and other stuff, which aren't a big portion of it. A lot of it's mostly about the carried interest profits of future gains.
And the final, so let's say if it's a non-OZ, so the final project realizes a certain capital gain, and that's like, let's say it's a big amount. You don't go to reinvest it, right? It's not a fund. It's not a private equity fund. You don't really reinvest it necessarily. So what happens in most cases in tax terms?
Yeah, you pay taxes or you invest it into something else and you get more losses and you get bonus depreciation losses, right? If you're able to then always cycle into a new investment and take bonus depreciation, which is borrowing from the future and past, and eventually one of these cycles, 1031 exchange, and you can't 1031 exchange it to syndication. The syndication itself has to go on the new title. Jointly, all the shareholders probably need to agree to join in. People can exit out. So this is a careful, thoughtful planning from the syndicator himself, which I try to facilitate. I'm typically the biggest investor in every one of these deals. I don't want to pay taxes. I want a deferred future. I will tender exchange the property from the investment vehicle, the title, syndication into the next thing.
So essentially, you need to get the permission of the current limited partners in the deal, and you can sort of proceed with using the same entity. Since for continuation, it needs to be the same entity that continues into the next deal.
Yep.
Mm-hmm. Makes sense. Okay.
Yeah.
Hi, got a quick question. Actually, two questions, if you don't mind answering them very high level. One, you talked about Airbnb shifting that from active to passive. I didn't get that. Airbnb income to rental income. That's one. And two, can you talk a little bit high level about sourcing and managing out-of-state deals?
The first one is when you make renter income from Airbnb, which is usually short-term rentals, that's classified as active. Passive is typically more tax advantage because you can use depreciation in other vehicles to write that off. Tax rate is the same, but more advantage. So if you have two entities, one Airbnb entity that rents to Airbnb, gets Airbnb rental income, and then does a long-term rental to another entity that you own as well, that transform the rental income to long-term rental income, which is passive income, more than 31 days a month, I think. I don't know the exact rules. Then you essentially transform active to passive. The next question of managing out of state, it's all about processes. I invest in multiple things out of state. I live in San Diego. I have nearly 1,000 units in Kansas City. It's a lot about relationships and building. It's really no secret sauce to this. You gotta just travel and grind it out. In terms of, you can invest in something like me, Tozy Capital, and learn the ropes there, or just try in this turnkey investments, which losing a little bit of control. I always think scale is more important, and then creating process. I've bought stuff that are very close to me, and I almost never go see it, because why would I put myself to put a $15 an hour job when I can hire somebody and make it a business? Then it becomes an investable business. So I always try to think of things along those terms.
Thank you.
And I have a personal question. Sorry. I'm very fascinated by your story. I think it's very neat. So I noticed that you said that in one of the first slides. So you were living in DC, but decided to invest in a property in LA. So what was your rationale for that? Because I'm avoiding California because personally I feel that income tax is very high there. So
Yeah.
I live in East Coast.
I would totally avoid
yeah,
California
yeah.
now. I grew up in LA. I grew up in LA, and I fly to LA every now and then. Back then, the property that I bought was $126,000. I put $30,000 down, and it was $200,000 like 6 months ago. It was a foreclosure. It was still renting, still made money. 2 years later, I went to Peace Corps and I still bought the property. So it's the reason why I bought it was because of proximity to my parents, proximity to like a support system there. So a little bit of a cheat. But that got me in the habit of learning how to manage out-of-state renters and eventually property managers. I would not invest in California now. Obviously developing that's different. If you're looking for appreciation with some inside information, that's different. But I almost always invest for cash flow.
Okay, thank you. Thanks for sharing that.
Any other questions, guys? If you wanna speak up or put them on the chat, we're over time, so let us know.
All right, guys, it was a pleasure. I put my contact information in chat. Feel free to reach out. Love talking about taxes. I have 8 days to help all my OZ investors get into an OZ. Lots of people are asking questions. TurboTax does not allow you to file an OZ. It's so many interesting things. By the way, I'm not a CPA, and the thing is that I almost always have to tell a CPA what to do. It's like, why don't you guys know this stuff? It's like, just Google it. So you just the lesson here is you gotta be very self-interested in learning about not paying your number one expense life. No CPA will be that proactive for you unless you have a lot of money, and then you can pay very good CPAs. But you generally have to be very self-interested to learn. Hopefully you learn a lot. So many other ways to do it, but it becomes easier when you're self-employed or when you own real estate, which is essentially a business, a self-employed business. And so lots of ways to do it. Hopefully you guys learn a lot.
Awesome. That was great. Thank you so much, Taing. That was so much information and very useful one. And I just want to, so to people who are listening to the recording, so you can reach Taing at tuesdaycapital.com or his website, tuesdaycapital.com. So with that, thank you so much. So appreciate having you here. Appreciate thanks to everyone who joined, and have a nice evening. Thanks.
Thanks, guys. Take care.